So, you want to own an airport fuel farm. It seems simple. Buy the tanks. Buy the land. Sign a contract with the airport. Sell jet fuel to airlines at a markup and collect the difference forever because planes will always need to fly. That's the pitch. But here's what almost nobody realizes. The fuel is the least profitable part of the operation. Some of the most successful fuel farm operators barely make money on the fuel itself. In some contracts, they lose money on it on purpose. So if the fuel isn't the business, what is? Stick with that question. By the end of this, you'll never look at an airport the same way again. Part 1. The illusion. The illusion is that a fuel farm is a gas station for planes. Bigger tanks, higher stakes, same idea. It isn't. A gas station sells you fuel and lets you go. A fuel farm is closer to a private utility, one that stores a flammable liquid instead of electricity. And like most utilities, the value isn't in the product moving through the pipe. It's in controlling the pipe. Whoever owns the storage, the hydrant lines, and the delivery infrastructure at an airport owns a toll booth every airline has no choice but to pass through. You can't truck jet fuel onto the tarmac yourself. You need the tanks, the pipelines, and decades of accumulated approvals just to be allowed to touch an aircraft's wing. That's the real business. Not selling fuel. Owning the only legal door the fuel is allowed to walk through. Part 2. The cost of getting started. Here's where the fantasy breaks. A mid-sized fuel farm, serving a regional airport, typically costs somewhere between $15 and $40 million, depending on tank count and how much pipeline has to be laid across active taxiways. Larger hub facilities can climb past $100 million. Land is rarely the expensive part, since airports usually lease it. But that lease hides its own trap. Authorities often charge rent based on throughput potential, not current usage, meaning you can pay for volume you haven't sold yet. Then come the tanks. Above-ground steel storage tanks with secondary containment, now required almost everywhere, run into the millions each once you include corrosion protection, vapor recovery, and fire suppression. And that's before a single gallon moves. Add hydrant pipelines threaded beneath the apron, at a cost that can exceed $1 million per mile. Add fire code compliance, seismic bracing, blast radius setbacks from terminals, and aviation authority approvals that can take years, not months. Insurance alone can shock a new owner. Environmental liability coverage can run 6 figures annually before a single claim is filed, because insurers know exactly how expensive a spill becomes once it reaches groundwater. Most new entrants budget for the tanks. Almost none budget for the permitting, the insurance, and the multi-year approval gauntlet standing between them and their first sale. Part 3. How money actually flows. So, where does the money actually come from? The primary revenue is the fuel markup, usually just a few cents per gallon. It sounds small because it is. On a single 737 fill of around 6,000 gallons, a 2 or 3 cent margin might net less than $200. That's the business everyone assumes is lucrative. The real money hides elsewhere. First, throughput and storage fees charged to fuel suppliers who need somewhere to park product near the tarmac. You're not just selling fuel, you're renting space in the only warehouse in town. Second, long-term into-plane contracts with airlines, often 5 to 10 years, which convert an unpredictable business into something closer to a bond. Airlines want guaranteed supply almost more than the cheapest price, letting operators lock in margin certainty. Third, and almost nobody outside the industry knows this, fuel farms often earn meaningful income from de-icing fluid storage and government or military contracts, which pay a premium for guaranteed priority access during shortages. Where does every dollar actually come from? Increasingly, not from the fuel, from guaranteeing access to it. Part 4. The hidden costs. But here's where everything changes. Maintenance isn't optional deferred spending like it might be for a warehouse. Tanks require internal inspection every several years, meaning draining, cleaning, and taking a multi-million-gallon asset offline for weeks. Environmental compliance is relentless. Groundwater wells need regular testing. If a leak is detected, remediation can run into the millions, sometimes tens of millions, surfacing years after it actually occurred. Then there's staffing, certified operators, and round-the-clock monitoring, because a fuel farm sitting near a loaded aircraft isn't a place regulators let you run lean. Add debt service. Since these facilities are almost always financed, interest on that $15 to $100 million bill can consume a significant share of revenue before a single operating cost is paid. And add obsolescence. Tanks built to yesterday's environmental code often need retrofitting when regulations tighten, which they reliably do. That seems like a small detail. It isn't. Regulatory tightening has quietly bankrupted more small operators than fuel price swings ever have. Part 5. The Economic Engine. So, what actually makes this business profitable? One principle: capacity utilization against a fixed cost base. The tanks, the pipelines, the permits, the insurance, almost all of it is fixed. It doesn't change whether you move 1 million gallons a year or 50 million. Which means the entire economics hinge on one number: how much of your fixed capacity is actually being used. A facility at 40% utilization can lose money every year. The same facility at 85%, with the same tanks and staff, can throw off enormous margins because the marginal cost of pumping one more gallon through an already built system is close to nothing. This is why operators fight so hard for exclusive, long-term contracts. Not to eliminate competition for its own sake, to guarantee the throughput that turns a fixed-cost money pit into a high-margin machine. That's the real business. Buying certainty of volume against a cost structure that barely moves. Part 6. Psychology. Airlines don't shop for jet fuel the way you shop for gasoline. They can't switch fuel farms mid-route, and a supply interruption can strand aircraft and cost far more in delays than the fuel itself. So airlines pay a premium for the psychological comfort of guaranteed availability. Governments buy in for a similar reason. Aviation fuel security is treated as critical infrastructure, and disruption at a major hub creates ripple effects far exceeding the value of the fuel. Investors love these assets for a reason that has nothing to do with airplanes. Long-term contracted infrastructure with predictable cash flow behaves like a bond with a yield attached, exactly what infrastructure funds are built to chase. Competitors fail for a very human reason. They underestimate how much of this business is regulatory endurance rather than operational skill. Part 7. Real failures. Independent fixed-base operators across the U.S. learned this during the 2008 downturn, when smaller regional fuel providers collapsed as general aviation traffic cratered, leaving fixed debt against evaporating throughput. Many were absorbed by larger consolidators who could spread fixed costs across dozens of airports. Environmental liability has quietly ended even more careers. Legacy fuel facilities at older municipal airports, built before modern containment standards existed, have faced multi-million-dollar remediation orders once contamination was discovered, sometimes forcing owners into bankruptcy. And the 2021 Colonial Pipeline shutdown, though not a fuel farm itself, exposed how fragile fuel logistics really are. One disrupted pipeline rippled into aviation fueling along the entire U.S. East Coast within days. The lesson each time is the same. This industry doesn't punish operators for bad luck with fuel prices. It punishes them for underestimating fixed costs and how thin the margin for error really is. Part 8. The math. Say a mid-sized fuel farm moves 30 million gallons a year at an average net margin of 4 cents per gallon across fuel sales, throughput, and storage combined. That's roughly $1.2 million in gross margin. Against that, annual operating costs, staffing, maintenance, compliance, insurance might run $500,000 to $800,000. And debt service on a $25 million facility financed over 20 years could consume another $400,000 to $600,000 annually. Run those numbers and you can land anywhere from a modest six-figure profit to breaking even, depending on utilization. Push that same facility to 90% capacity instead of 60%, without adding a single tank, and profit can more than double, since almost every extra gallon is close to pure margin. That's operating leverage in its purest form. Part 9. Best case versus worst case. Best case. You secure a 10-year exclusive contract with a major carrier, utilization climbs above 85%, and your fixed-cost facility becomes one of the highest margin assets at the airport, generating steady, bond-like returns for decades. Worst case, you build the same facility, win only short-term contracts, a regional airline cuts routes, utilization falls under 50%, an aging tank fails inspection and needs an expensive retrofit. And the same asset becomes a slow-motion bankruptcy, 3 cents of margin at a time. Same tanks, same location, same fuel. Completely different outcome, decided years before a single gallon was ever pumped. Because in the end, you were never really buying a fuel farm. You were buying a very expensive machine that converts guaranteed access into guaranteed cash flow. The fuel is almost incidental. It's the excuse the machine needs to exist. And whether that machine makes millions or quietly drains a fortune 1 cent of margin at a time depends entirely on whether you understood the economics hiding beneath the tarmac before you ever signed the lease.